excited to be the sponsor of today's webinar. GradSave is the first of its kind online financial advisor dedicated to college savings, helping families choose an optimal 529 plan and open easily online. We also have financial advisors that specialize in 529s available for further questions. So for all the participants in today's webinar, we're waiving all the fees through May 31st, so please visit us at gradsave.com/529day and check us out. More importantly, I'm very excited to introduce our moderator for today, Tara Siegel-Bernard, a personal finance reporter for the New York Times. Before joining the Times in 2008, Tara was a deputy managing editor at FitLife, a personal finance website, and a news editor at CNBC. She also spent a decade at the Dow Jones, where she wrote a weekly personal finance column and was a regular contributor to the Wall Street Journal's small business and health cost columns. So with that, Tara, it's all yours.
Great. Well, welcome, everybody. Thanks for joining us today. Clearly, saving for college and paying for college is a onerous and stressful process in a world where our salaries don't often keep pace with the escalating costs of tuition. But the more informed we are, the better consumers we are, and that's why we're all here today. So let's start. Let's jump right in and talk about, introduce our panelists. We're joined by 3 experts who are ready to answer all of your questions about 529s, saving and paying for college, and more. First, we have Joe Hurley, who is the founder of savingforcollege.com, a comprehensive source of information on anything and everything 529 and other college saving topics. He's also the author of several books on the topic. And then next we have Lynn O'Shaughnessy, a nationally recognized college expert and author of the Amazon bestseller, The College Solution. She also writes about the issue on her blog, thecollegesolution.com, and on cbsmoneywatch.com. Finally, we are joined by Troy Onink of Strategy. He's the chairman and CEO there, and that's a firm that offers college planning advice to families and licenses college planning software to financial advisors. He also contributes to Forbes, where he writes the blog College Crossroads. So with that, let's jump in. We have a lot of questions that you sent us in advance, but feel free to send us more about, and again, anything related to about saving and paying for college. Doesn't have to be limited to 529s. There are a few ways you can send us your questions. The first way is via Twitter, if you're on it, using the handle @529day, or through the chat box, which should be in the control panel on your screen on the right side. So let's get started. Actually, before we get started, I thought it would be helpful. Most people know what a 529 is, but I thought it would just be helpful to, and I'm going to read this straight from one of my stories, what it actually is, just to give a basic definition. It's a college savings account where all contributions grow tax-free. The money can be withdrawn without paying capital gains taxes as long as the proceeds are used for education expenses. And a lot of states provide state income tax deductions. So with that as a kind of a baseline, I thought I'd jump into some of the more specific questions. The first one comes from Kathy H., and it has to do with picking a plan. How do I know whether or not I should choose my state's plan, with the benefits being state tax deductions versus another state's plan that may or may not better? When do the state tax deductions not outweigh another state's quality of plan? So Joe, I thought we'd kick off with you.
Start with a pretty tough question, but one that is asked in many states, because about 30 states offer a state tax deduction or a credit, but only if you use that state's 529 plan. So if you use another state's 529 plan, which you're certainly allowed to do, you may be walking away from a state tax benefit. So what's better, staying within your state and getting the benefit of that tax deduction, or going with an out-of-state plan, presumably because you think it's a better plan, will have better performance, some other feature that attracts you to an out-of-state plan. The state tax benefit is an important benefit. It's dollars in your pocket, risk-free, so it's certainly not anything to overlook. And so anyone out there really does need to consider their own state's 529 plan, even if they're looking out of state at the same time. You need to know what that benefit is and how much it can help you. Many states put a cap on the amount of tax deduction you can take, so the actual dollar figure may not be all that high when you factor in the capped deduction amount. And the other thing I would mention, a couple other things I would mention, and then if Lynn or Troy want to add, I'd be happy to have them do that. You can actually open accounts in more than one state. So if you have enough money that you're putting into a 529 and you want to take full advantage of your state's tax deduction by putting the limited amount into your state, and then if you have more money, you opening an account in a different state, that's perfectly acceptable. The other factor that I think you should consider is the age of your child, because if your child is young and has many years before college, then investment performance becomes a much more important factor than the state tax deduction because you have longer investment performance period. If your child is older, let's say a sophomore or junior in high school, it's very difficult to walk away from your state tax deduction and earn it back through another 529 plan. So you really have to take that into consideration.
Great. And then Lisa,
I could add about that just because I've written about this before. For some families, you can even make contributions when your child is in college and then take them out shortly thereafter, just after you've captured the tax benefit. So in some cases, you can take it out the next day, or so that's something that people should be aware of to capture a really easy tax deduction.
Yeah, that's a great point, because some people feel it's too late to save for college because their kid's already in college. But as Lynn mentions, if you're in a state that allows you to deduct your contributions simply by flowing your tuition bill through your 529 plan, you're making it deductible for state income tax purposes, which you can't get any better than that.
Excellent. And so Lisa S. has another related question. How do I narrow down which 529 is best? What questions should I be asking in order for me to choose the right one? Troy, you want to kick that off?
Yeah, the biggest thing that has happened with 529 plans in that regard in recent years is the fees within the plans and the investment management fees have all come down. And it's kind of been a race to the bottom for a lot of the plans and the managers. So that has been a big benefit to the consumer and the investor. And if you can focus on the plans that have the state tax benefits that were just mentioned, and then start to look at the plans that have the lowest fees, but also have the best investment options based on what your time horizon is and your risk profile is, then you can really start to hone in on the plan and the investment option that is going to be best for you. And going back to the discussion that was brought up just a few minutes ago, the other aspect that we have to think about is that a lot of students these days are going on to graduate school, so it's a good idea to keep a lot of that money in a 529 plan and get that continued growth of that tax-deferred earnings and use that later on when they're going to be going to graduate school. So sometimes spending other assets first can prolong the benefits of tax and so forth that you're getting from the state plans that offer that tax advantage, and you can continue to make contributions. So those are some of the big things that I focus on, really are trying to narrow down the plan and the option by fees and by your time horizon, the investment options, and then also making sure that you're going to use the right account at the right time as you're going through that process. Which account should I use? If you have a custodial account, maybe you should use some of that money first and then use the 529 later. But you also have to remember that using the money that's in the 529 for college purposes, that's where we're going to get that tax-free distribution. You don't want to, prolong this too far and then not use it for college purposes.
Right. You had mentioned fees, which kind of is a good segue into, brokers versus direct plan. Amy W. has a question. What are the biggest differences of direct sold versus broker sold plans? Lynn, do you want to take that one?
Well, I think if you're on this call, right, if you are researching 529s, if typically the people who are more knowledgeable of 529s, they can do this themselves. This isn't rocket science, right? It's just picking a plan. And if you pick an advisor plan, it's going to cost more because the advisor has to be paid for the time that he or she spends selecting the 529 for you and answering questions and, you know, overseeing this account. So if you're a do-it-yourself person, just pick one yourself. And if you feel like you don't have, you know, the knowledge, or you don't really have the time to figure out what's a good one, then you can go with an advisor. But you need to be aware that advisors typically at some firms, they can only recommend certain 529s. So if you go with an advisor, you have to be aware that the universe could be quite cramped. Right. So that's something you should ask an advisor is, which ones do you use and why is that? What are the fees for this service? Because I think a lot of people just think, hey, it's free, because they don't write a check to the advisor, right? They just, all of a sudden, they've got an account, a 529 account, they never have a bill. So that's something people really need to be aware of, is that they are paying. It's just through the fees embedded in the 529.
There are some general structural differences between advisor and direct sold 529 plans. The advisor sold plans tend, not as a rule, but tend to use actively managed funds, which are higher cost mutual funds. They tend to have more investment options because there's an investment advisor there to help sort through all those options and help select which option is most appropriate. The direct sold plans, for the most part, have gravitated towards index funds. And so many of the direct sold plans have these very low cost index funds, but because index funds are essentially all alike based on the same index, you're not going to find much difference between the states performance-wise, except for fees. And that's where fees become even more important, is if you're comparing two different plans, both of which are using index funds as the underlying investments.
Right.
I would just add to that, where the advisor does come in to play a key role is in the investment selection. And as Joe just mentioned, a lot of the direct plans have a lot of the same index funds in there, so that you have the generic market representation in those investment options. And in the advisor sold plans, you have more investment options that are more direct participation. They're being actively managed by investment managers. And you know, like we saw going into 2007 and then the market decline in 2008, 2009, that's where having some advice as to whether you should make a move or not make a move before or after or during these market changes, when we have cycles go through, we need to be able to make good decisions at those points in times and not jump out of the market when the stocks drops, you know, 40 to 50% over that period of time. So that's where I think an advisor plays a good role. But to echo what Lynn was saying, this isn't rocket science either.
Yeah,
right.
And I don't know how you guys feel, but if someone is looking to use an advisor just to choose a 529 plan, that's probably not a good way to go. But if you're using an advisor to do your retirement planning and your help with your estate planning and look at sort of the whole financial picture, where 529s might be one piece of that, then it certainly makes a lot more sense to use an advisor sold 529 plan. But as a standalone, I just need a 529 plan. Should I go see an advisor to choose one for me? For most people, that's not necessary.
Right, and you could call up your fee-only advisor if you use one where you know what you're paying, and have them help you choose the best direct sold plan. That's probably the most economic way to go, another good option. So let's talk about prepaid plans. Nineton wants to know, is a prepaid tuition plan better than the kind of more traditional 529 college savings plan? Joe, you want to take that?
Prepaid plans are only offered in about half a dozen states right now, actively offered in those states. And typically you need to be a resident of the state in order to use their prepaid plan. So if you're in Florida or Michigan or Nevada, you have a prepaid plan that you can use, and it's an option to think about for the tuition piece of the puzzle. Uh, Basically, a prepaid plan allows you to pay in today, and the plan will pay your tuition in the future, your child's tuition in the future. So it could be a good deal if tuition continues to go up very rapidly, because basically, like an insurance product, it's someone else who's taking on that risk. However, there's a price to pay, and the prices being set today for prepaid plans in many cases are well above current tuition levels. So you're paying a premium above current tuition just to get into the plan, and so that definitely affects the economics. And there's one other prepaid plan out there that's not run by a state. It's run by a group of private colleges called the Private College 529 Plan, and they represent something over 200 different private colleges around the country, and that does allow you to pay today's tuition price at a college and then receive future tuition for that payment.
And then what if your child chooses not to go to that college?
Well, under that particular program, your child can go to any one of the 280 participating colleges, but if they go to none of those, you essentially cash out of the plan to use for whatever college that child does go to, and the plan will pay you what you paid into it plus or minus 2% per year based on investment performance. So you can pretty much assume that you'll get a 2% return on your investment in that, even if your child goes to a different college.
Got it. And then there were several questions about the impact on financial aid. Diane J. asked, how do 529 plan assets affect financial aid? And, how are they taken into account? This comes from Les B. How are 529 plans taken into account when determining financial aid and or scholarships? Troy, do you want to take, or Lynn? Okay.
Sure. Go ahead, Lynn. You start off.
Well, I just thought I'd give an example because, I give a lot of talks and I meet with a lot of families, and there's always parents, usually the dads, that are obsessed with this question. And, they felt good over the years saving for college, right? They got their 529, they're feeling really good. And then when their kids get to high school, they start treating this 529 like it's some kind of time bomb that's going to blow up in their face, right? And they start feeling resentful that they've saved, they've been responsible parents, and yet they're looking at other people who haven't saved, and they feel like these losers, as they call them, are going to get all the money, right? And they're going to be penalized. And that is so not true. It's always good to save, whether it's 529 or not. And one of the reasons is when you file for financial aid with the FAFSA, for instance, everybody gets an asset allowance that's based on the age of the oldest parent. And it changes every year, this asset allowance. It's in the expected family contribution formula. So if you just Google EFC formula 2014-15, you'll find it. It's on page 19 of the whole formula. And it'll show you, based on what your age is of the oldest parent, how much you can shelter in non-retirement assets. Okay, so in this year, for instance, the 2014-15, for a parent who's 55 years old, I think it's, let me see, I got it here. I think it's like 39,700. So if the parent did a really great job of saved $100,000, in a 529 or other accounts, they would get to shelter 39,700, and then that would be subtracted to the 100,000, and what you would get would be that figure would be assessed at 5.64%. Okay, so having saved, $100,000, I've got it somewhere here, you would end up only having your expected family contribution would only go up by $3,400. So I think the bottom line is, I think way too many families worry about how savings are going to impact their financial aid. The biggest driver is really people's incomes, and that people should just save. If you've saved a tremendous amount, hundreds and hundreds of thousands, well, good for you. You're going to be ahead of the game. You're going to have far more choices for college. And also, in that case, you would look for schools that give merit scholarships to high-income students, of which almost all of them do. So for most people, this is going to be a non-issue, I would say.
Great. And that issue is related to, who owns the 529 plans. So Michelle S. Has a question about, can a 529 plan be owned by a child? And somebody else had a similar question, who should be listed as the beneficiary, child or parent? And how does that impact the financial aid implications?
Well, on the issue of who owns the accounts, that has a great bearing on what that impact to the student's expected contribution toward the cost of college is going to be. And there we have to start looking at the fact that there are 3 different ways in which they calculate the student's contribution toward the cost of college, or what's referred to as EFC, expected family contribution. So if it's a school that just uses the FAFSA form, all the colleges out there who are going to dispense any federal or state aid are going to just require the FAFSA. Some of the private schools and a handful of flagship state universities will also use a subsequent form called the CSS profile. And under the CSS profile, there's actually 2 calculations that they use for EFC. One is the institutional methodology, and the other is called the consensus methodology. So going across the board with student-owned 529 accounts, if the money is in a student-owned or a custodial 529 account, then it's actually going to get treated not at the 20% that it normally would if it was in just a regular savings account. It's actually going to get treated at up to 5.64% because they actually treat it as a student-owned, or excuse me, a parent-owned 529. So even though the student owns the account, if it's in a 529 plan or if it's in an education savings account, then that asset does not get treated as a student-owned account. It gets treated as a parent, and it's at 5.64% maximum. But when you start looking then at schools that are going to be using the CSS profile under the institutional methodology, they don't care if it's in a 529 plan. They're going to count it at 25% if it's in the student's name. The student being the owner of the account, the parent as the custodian. But under the consensus methodology, they don't care if the money is in the parent's name or the student's name. They treat it all at 5%. So in that case, there's 26 institutions that use that formula, and under that formula, it doesn't matter if it's a student-owned or parent-owned 529 plan. It's all going to be at 5%. So college selection and which colleges you're really starting to look at can play a big difference, big role in how that expected family contribution is going to be arrived at related to the 529 account. So it's important to understand how the rules work under each of the formulas and which schools use which forms.
Got it.
Of course, the vast majority of schools use the FAFSA and only the FAFSA. I mean, we're talking about a teeny tiny percentage of schools that use the profile or consensus. So for the vast majority of people, the 529 is going to be treated as assessed at a parent asset at a maximum of, 5.64%. So.
And remember what Lynn said was that income is most important. One of the big benefits of 529 plans is that the income or the earnings accumulated never get reported on a tax return and therefore do not get picked up on the FAFSA and do not have to be added back to the FAFSA like some other forms of untaxed income. For example, if you use your IRA to pay for college, those IRA withdrawals, even if they're not taxable on your tax return, have to be added back as income on the FAFSA and can have a very severe impact on financial aid eligibility. So there's really a nice benefit there for 529 plans in the treatment on the income side of the financial aid formula.
Got it. And that actually brings up another good point. Grandparents. A lot of grandparents want to contribute. And Cynthia C. writes in and asks, as a grandparent, which name should I invest in, mine or the parent? What if the parents divorce? You want to take that, Joe? Sure.
That's a great question. Grandparents wonder what these 529 plans are. A lot of them, it's kind of a concept that's hard to get a grasp of. And I always tell grandparents, I say, well, you need to decide whether you want to control the funds or not, because you have the right to control the funds if you're making the contributions, which means you have the right to revoke those funds if you decide later on that you want them for something else, or to redirect those to a different grandchild, for example. But at the same time, if you just want to make contributions and not have to worry about receiving statements or making decisions in the future, why not just make your contribution to a 529 plan that's owned by the parent? That way the parent takes control of the account. The parent makes the decisions on when to take money out and what to use it for. And after all, the parent is typically the one ultimately responsible for their child's college costs. So in those situations where the grandparent really doesn't have a good reason for wanting control of the account, I would say, put it in the parent-owned 529 account. The gift tax rules, which we haven't talked about yet today, are the same whether you put it into your own account or put your contributions into somebody else's 529 account.
Got it. A kind of mechanical question on that point. How does a grandparent actually set up the account? Is there any special information that you need? That comes from Paul B.
Well, anyone can open an account just using the application form that the 529 plan makes available. And many times these forms are online. So if you get on the computer, you can fill out the form online and actually make your contribution online. All you need to do on the form is indicate who the account owner is, who the beneficiary is, and which investment option you wish to use in that particular 529 plan. Then it's set up, your money is invested in that investment option, and then you can either make additional contributions in the future or just let the account leave it alone and just let it hopefully grow in the future.
One thing that I think grandparents should know, if they did set up the account, they didn't take Joe's advice and just don't, contribute to a parent's 529, is hardly any school in this country, none of the FAFSA schools, for instance, so almost no schools in the country care if grandparents have stuffed money in a 529 for the grandchildren, right? It doesn't even come up as a question on the FAFSA, which is, for those who don't know what that is, it's a free application for federal student aid, and if you want to get any kind of financial aid from any school in the country, you're going to fill that thing out. The profile schools, there's 250 schools, almost all of them private. A few of those schools might ask, but I think it's rare if grandparents or anybody else outside the immediate family is saving for the child. So in most cases, grandparents could amass a lot of money in 529s, and it's not going to hurt their grandchildren's chances for financial aid at all until they take it out of the account and start actually paying for college. And then that money is assessed at the student as a student asset, and it's dinged like 50%. So you don't want to do that. So what grandparents should do to avoid that happening is to wait until the child's parents have filed for the last financial aid application, in the child's junior year of college, right? So in the second semester of the child's junior year in college, the grandparents can, after the financial aid forms have been filed, the grandparents can just take that money out and then start paying for college. So that's the easiest way, the best way, where grandparents' assets in a 529 will never impact a child's financial aid chances.
Sonal S. has a question that Joe touched on, but if we could talk in a little bit more detail about gift taxes. Are contributions to 529 plans by grandparents subject to a gift tax, and can you open more than one 529 plan per beneficiary? Troy, you want to take that?
Yeah, there are some rules that definitely have to be abided by when we start talking about gift tax. And right now, for 2014, you can gift $14,000 per year per person, $28,000 on a joint tax return, husband and wife. And that can be front-loaded. Those contributions can be front-loaded in a 529 plan, and then they average that gift out over the 5-year period. So that's a way to get the money into the account and get it growing and not have to deal with having to file the gift tax return if you're exceeding that $28,000 a year or $14,000 to an individual. So the 529 plan has a special rule in this regard that really makes it beneficial for the investor, the family member that can make that sizable contribution. And it does get prorated as far as estate planning purposes. So as the years go by, then that estate planning tool that you're using here by gifting that money, it's coming out of your estate. And if the donor were to, the person that's putting the money in, were to pass away before that 5-year period, then they only are going to use that remaining share of that gift tax exclusion that would get added back to their estate. So if you have some, good healthy grandparents, this is a great way to get money out of their estate and also have that beginning to grow tax-free for college early on.
Right, yes. Sharon Ike asks, if the grandparent opens the account, what happens if the grandparent passes before the child gets to college?
Go ahead, Joe.
Well, the account lives on, so it's simply a new account owner that steps in the shoes of the grandparent, the former account owner. So when you actually file the application, most plans ask you to name a successor owner in case the original owner dies, and then that successor owner simply steps into the shoes of the original owner. So the 529 account can actually stay in existence for generations. It can keep getting passed down from one generation to the next. Number one, because of the account owner changes, and then number two, beneficiary changes. You can always change the beneficiary of the account down the family tree, and therefore if there's extra money in there that's not used up for the current beneficiary's college, it essentially just becomes a huge education trust going into the future, family education trust. So it's a very valuable tool, and as Troy mentioned, it's outside of the estate. So you've managed to remove all these assets from a taxable estate, and it's essentially squirreled away for future college expenses for whatever member of the family may have use for it.
On the related topic of family, Marie has a question about nieces and nephews. Can I get IRS deductions for investing in savings plans for my nieces and nephews and my late husband's nieces and nephews?
Well, I'll start on that because we're talking about state deductions here. You don't get a federal deduction for your contributions to a 529 plan, and so it's the rules in your state that that matter. Most states don't care who the beneficiary is. If you're making contributions to a 529 plan, usually to that state's 529 plan, then you're allowed to take the deduction. A couple of states have exceptions, and the beneficiary must be some relation to the account owner. So you just have to look at your own state's rules, because all the states are different with respect to their own deduction rules.
Got it. And then several people had questions about some of the the basics. Christine G asks, how much can I give per year? Lynn, do you want to take that, or Joe?
Well, I mean, you can. I think they already discussed the whole gift tax. You can contribute up to $14,000 a year per, and if you're married, that's $28,000 per child. So that's a lot. I mean, most people, frankly, don't have to worry about the maximum they can contribute, because it's not going to happen. But I mean, I guess you could be aware of that. Though, even if you are cutting into the gift tax exemption, I mean, the gift tax exemption is huge, right? I mean, I really wouldn't worry about it. If you're that generous and you can give a lot of money, good for you. But I mean, aren't all states though have limits, lifetime limits of how much you can stuff into these accounts, right, Joe?
Right. Yeah, unlike an IRA, there's no annual limit though. With an IRA, you're limited to what, 5,000 or 6,000 per year. With a 529 plan, there may be a maximum contribution limit of $350,000. You can put all that in on one day if you wanted to, and were fortunate enough to have that much money. Yes, you'd have a gift tax issue, because it would be much more than even the 5-year amount, which is $70,000 for an individual and $140,000 for a couple. So you would have taxable gifts, But as Lynn mentioned, everyone has a lifetime exemption against gifts. This year, $5.34 million. So you're not even coming close to that. So the biggest hassle is just having to file a gift tax returns if you fall into that particular level of gifting. But beyond that, most people are not going to be facing a gift tax problem, even with very large contributions into a 529 plan.
And then Lily P. asks, is there an age limit for the beneficiary or a relationship test? Troy, do you want to take that?
There really isn't an age limit because the account can continue on, and that's true with a 529 plan, but it's not true with an education savings account. So some people might still have both types of accounts, a Coverdell education savings account, and once the beneficiary reaches age 30, then they take over control of the account. With a 529 plan, that's not the case. The owner remains the owner, and they can even change the beneficiary if they choose to do that.
Okay.
And you can open a 529 account. It doesn't have to be a relation to do that.
And you can open an account for yourself. You may be thinking about squirreling away some money and going back to college and retirement, as I have, and use 529 funds for. Not that I'm retired, but I am going back to college now, and use 529 funds for that purpose. So they're very flexible as far as that goes.
And you get the same state tax deduction, right? Luke K. asks, if you contribute to your own 529, do you receive tax benefits from it?
Yeah, you'll get the same state tax benefit if you do that.
Okay. Then lots of people have questions about the use of funds. Michelle W., what can be used with 529 funds? Example, laptop, college books. Who wants to take that one?
Can't
Lynn?
you use laptops if it's required by the school, where you can have books covered? But Joe, you would know that. I mean, what is the computers are a little gray area.
Yeah, computers are sort of a gray area. I mean, the list of qualified expenses includes tuition and fees and required books, supplies, and equipment. There's another category of special needs expenses for special needs beneficiaries. And then there's room and board, which is subject to limits and requires that you be at school at least half-time, which the other categories do not require that. So computers, most schools do not require that their students come to school with a computer. And so in those cases, a computer would not be a qualified expense, which is ludicrous because practically speaking, all students really do have to have their own laptop at school. And that rule, I think, will change shortly. Congress is considering a law that would allow computers to be qualified expenses. But the categories that people question often are transportation, which is not a qualified expense. Repayment of student loans is not a qualified expense. But those other categories are as I mentioned.
And that doesn't bode well for this next possibility. Can a parent purchase a house with funds from a 529 and have his child live in the house while in school? That comes from Mike P. Troy, do you want to take that?
Yeah, actually, we were discussing that before the webinar started, and you can take distributions from the 529 tax-free for the housing expense that Joe mentioned, and there are limits on that. That's set by each school. And that the student could then use to help pay their rent, which if that rent happens to be rent to your own property that you own as mom and dad, then that's fine. But you can't take, go and buy the property 2 years ahead of time and use 529 money to do that. It's only while the child is in college that's when that distribution is coming out tax-free. So it's a good strategy a lot of times to have real estate in a town like that and have your children staying there, hopefully with roommates that are willing to pay an extra share of the rent as well. And in the case that your child is attending and the school has a limit, then you can fund that portion of your child's cost of living in your own home there that you're renting out. They can fund that portion of their cost through the 529 account.
Got it. Related question from Christine B. Can we use the money to pay for colleges outside of the U.S.? And what about culinary school, different types of schools? Joe, do you want to take that?
Sure. Yes, any school where students can apply for federal student aid is a qualified school for 529 purposes. And many foreign institutions are eligible under that definition because students can apply for Stafford loans at those schools. So if you're wondering if any particular school qualifies, you can go on the Department of Education website, ed.gov, and search for the school lookup code. And you can enter the name of a school, and as long as it has a financial aid code number, then it's okay for 529 purposes. If you want to look at all schools under a state, you can do that. If you want to look at all foreign institutions, you just enter the code FC in that lookup tool, and you'll see the list of foreign institutions. And many, culinary schools are eligible under that criteria. So there's a wide range of vocational schools, proprietary schools. There's a very wide range of post-secondary schools that do fit the definition.
Got it. There are also several questions about penalties. What happens if the money is not used for college? Is everything penalized? That comes from Keith A.
Well, not the full distribution. Some of the distribution that is being taken, it's a non-qualified distribution. So if you take $10,000 out of an account that you're not using to pay qualified education expenses, then a portion of that $10,000 would be subject to taxes and penalty, but it's only on the earnings. So if you had of that $10,000 distribution, let's say $9,000 of that was money that you contributed, and they have a way that they calculate that, then that other $1,000 is actually going to be subject to the tax and the 10% penalty for early withdrawal, but the other $9,000 isn't going to be taxable.
Got it. Okay. And what are the penalties to get money out if you need it for reasons other than school? I guess that's the same. Okay. Similar question. Several people also have questions about.
Yeah, just a quick point on that. If you're taking money out, if you have a scholarship, then you can take that amount out without having to pay penalty on that. And there are some other exclusions, for death and disability and things like that. The things we don't want to have happen.
Right. Okay. And then saving strategies. Sherry C. has a basic but probably very common question. How do I know how much I need to save for college?
Well,
Lynn, do you want to take that?
Yeah, one thing that I would say don't spend too much time on are those savings cost calculators, which will just freak you out and scare you because you'll think, oh my gosh, there's no way that I could possibly save that much. And one thing and they're on all the financial industry websites, how much is college going to cost in the future? They're really, the numbers are suspect because the vast majority of students get a break on the tuition price. About 2/3 of students in this country that go to state or private schools are not paying full price. They're getting grants or scholarships. And for students who go to private colleges and universities now, 87% are not paying full price, and the average tuition discount with grants and scholarships is 53%. So, I think the better question to ask rather than how much do I save is how much can I save right now? How much can I possibly afford? And I just think that families should try to find opportunities to save a little more. For instance, when my son just graduated from college last Sunday, so I'm done. I saved through 529s. I tapped the last one out. But when my husband and I were, saving when my kids were little, when my son got potty trained, we put more in our 529 because we weren't spending money on diapers, right? When my daughter got out of preschool, I put a little more in because we weren't paying for that. She was going to a public school. So just try to find ways that you can save a little more, and also for sure do it automatically. Have it an automatic pull it out of your account every month, so it's not a matter of, oh, should we do this, should we put a check in or not. And also at many 529s you can get started for next to nothing, and sometimes zero if you automatically save. So that's what I would suggest, is kind of focus on what you can save rather than looking at this like scary big number, in the future.
Right. And how should people think about balancing college savings with retirement savings? Michael S. asked that question. How do you prioritize?
Well, I think that
I always go ahead.
Oh, I don't know. I think you should do both, frankly. I think you can do both. I mean, I think retirement is the most important. With my husband and I, we both saved for retirement, and we were putting more in our retirement than we were for college savings, but then retirement is a much bigger sticker price. Mm-hmm. So I don't really think it should be either or. I think there is a way for most people to at least get some, save something for college, and also tell relatives, at birthday time or Christmas time, hey, just give us money for the college account, which is what we did with our kids. Our kids didn't even know they were getting presents when they were little from their grandparents, because we just said we want money for a 529. So I really think you need to do both.
Great.
I know one of the other questions that you get about trying to balance retirement and college is, when you start to save for college, the question comes up about how much should I save, and then a lot of times, as we've already discussed, people worry about whether that's going to hurt them for financial aid purposes. It's important to note that the money that's in the retirement accounts, you could have $1 million in your retirement accounts, and the money that's in those plans is not going to hurt you for financial aid. The contributions you're making to those retirement accounts in the year prior to which the student goes to college, that will get counted on the financial aid form, and they simply add that back to your adjusted gross income. So you can save early and a lot in retirement plans, and then maybe scale that back a little bit if you need to, and be saving for college. But the general rule is, save as much as you can, as early as you can, for both of those goals, college and retirement.
And a couple of people had questions about, saving when you have more than one child. Do you save more for one over the other? For the older one that's, going to be going to school sooner. What's your take on that?
Well, one thing that people need to be aware of is, if you are looking for financial aid, if you have two children in school at once, that can increase your chances for getting more aid, because the financial aid formulas that we've been talking about, the FAFSA, which most schools use exclusively, and then this profile that about 250 schools use, they give you a break if you have more than one child in school. So if, let's say you have one child in school and your expected family contribution is, you're very wealthy and your expected family contribution is $50,000, you're expected to be able to pay that for one child. Once you have two children in school, that expected family contribution for each child will go down by 50%. So this is something that I tell families, that if they're concerned about how they're going to cover the cost of two kids, if you've spaced your children closer together, you're not going to pay as much. I wish people who are still having babies knew this. When I talk to families with teenagers, they always laugh about that, like, oh wow, why didn't we know about this? So for those of you with young kids, space them closer together, have them in school at the same time. For those where, hey, it's way too late now, one thing they can do is consider having the older child take a gap year, so that the siblings will have more years in school than they might otherwise. And it can really save you some money. I mean, my children were spaced 3 years together, 3 years apart. And when my daughter was in school, they were in college for 1 year together. My daughter was a senior, my son was a freshman, and we had just gotten merit scholarships for my daughter. But when my son got in college, we had that 1 year where we actually got need-based aid because our EFC dropped. So that is something that families need to think about. I've had people say, oh no, I've got twins or triplets. It's like, actually that's a good thing, because we're for 4 years together.
And Tara, let me just mention with respect to 529 plans, that, the flexibility of 529 plans does allow you to use just one account and then intend to, split it out in the future if you have more than one child.
Okay.
I generally recommend that you set up a separate account for each child because, number one, it gives you more gift tax allowances because those are based on per child. Number two, they might be different ages, and if you want an age-based investment option, that would put them into different investments based upon their respective ages. And number three, I think it just makes for better family bookkeeping because if you just set up one account and name one child as a beneficiary and something happens, you get hit by a train or get disabled and somebody's left wondering, why did you open just one account for this child and not for this other child? That other child's going to feel pretty left out. So you don't want to do that to your children. So set up separate accounts for each child.
Just to add another point on that, going back to what Joe had said earlier about these plans can be multi-generational, and so when you kind of set them up that way to begin with, per child or per SERPES as they would use in legal terms, then it makes for easier accounting on an ongoing basis from generation to generation. It just flows a lot easier. So I agree, and the point that Joe made about having different ages for the students and using age-based investment options is a big one because that's where most of the money gets invested within 529 plans is in the age-based portfolio. So if you are doing this on your own, that's a very good point to take into consideration.
Right. Several people have questions about how 529 stack up to other accounts like IRAs. Jen D asks, can you provide the pros and cons for parents to save money in an IRA instead of a 529 plan? Joe, you want to take that, or Troy?
We'll tag team it. Go ahead, Joe.
Yeah, I can start it, and then Troy will weigh in on this, I'm sure. Well, we talked before about different goals, retirement and college, and really the need to make sure that you do save for your own retirement because no one else is saving for your retirement. When your child gets to college, there are other sources of money potentially available, including financial aid. But at the same time, I agree with what Lynn said before. Even if you're saving the bulk of your money towards retirement, you need to have at least a small 529 plan going because that keeps the goal of college squarely in front of you. You get those quarterly statements and you see how you're doing towards your college savings. And you have the opportunity to start contributing more if your income goes up and allows you to do that in the future. So it's really a balancing act, and Troy's helping people all the time try to get through that balancing act. So I'll throw it over to you.
Yeah, the idea of using one account versus the other is really not the way to look at it, which is what Joe was just saying. You really need to have both going if you can, and then. But to answer the question about what are the differences, the pros and cons between an IRA and a 529, an IRA is an individual retirement account. If you're not familiar with what the acronym means, and that is an account that's set up so that you can have that money grow tax deferred, and then once you get over the age of 59 and a half, then it comes out without penalty, but you're still taxed fully on that distribution. Now, if that distribution is happened to be used for college tuition, then there's no, and you take it out before age 59 and a half, then there's no 10% penalty on it, but you still have to pay the full taxable income. It's a taxable income due. You're going to pay tax on the full distribution. So that's not the ideal type of account to use for college. Whereas a 529 plan is growing tax deferred. If it's used for qualified expenses, as we've gone over here, then that money is going to come out tax free. So the 529 is far superior to an IRA. If you were to take a hybrid approach, there is an account called a Roth IRA where the money that you're contributing to that is not being taxed. You're not getting a deduction for the contribution, but the money in there is growing tax deferred. And once you get over 59 and a half, that can come out tax-free for retirement purposes or for any expense that you have. But if you were to take the money out of the Roth IRA before age 59 and a half, you're able to take out your basis or the contributions that you've made to that account. you're able to take that out tax-free. And then the earnings, if you start to withdraw the earnings portion, that's when you would have to pay a tax on that. So, and again, if it's being used for qualified tuition expenses, there's no 10% penalty on that. So really the IRA should be used for college, for retirement, and the 529 for college. If you had to kind of go halfway in between, Roth IRA might be a good option because it gives you the ability to take out your contribution tax-free, pay for college, and you kind of leave the earnings in there for your own retirement. So it's a way to kind of straddle both goals at the same time.
You know, another thing
you take out, I'm sorry, if you take out the contribution, is that then going to be counted on the next year's FAFSA as a?
Yes, yes, that full contribution or distribution, I should say, from the Roth IRA, whether it's taxable or not, that full distribution is going to get counted against the student or against the parent for income purposes for the next year. They'll add that back on the financial aid form the next year. If it's in the student's name, because some students have Roth IRAs, then it would be income to the student in that next year. So
if you're going to use it, wait till the very end.
Which is what I did.
Or if you don't have any, if the student doesn't qualify for need-based financial aid, then it doesn't matter.
That's what I did with my own son and my daughter. They both had Roth IRAs. I started for them, and I put some of the money for college into those Roths for them when they were actually, I mean, you can't set up a Roth for a kid until they actually are making income. I mean, making a salary, right? So my kids both had Roths, and I took it out. Well, my child wasn't getting need-based aid, so it didn't really matter. But I waited until, just in case, I waited till his last year to take some of that Roth money out, and then I also left some in so that he would, have a retirement account. Both of my kids have a retirement account now that they're out of college, and I've encouraged them to, now that they've already got this Roth, as they leave, that they will contribute automatically. And my daughter, who's been out of college for 3 years, does. She automatically contributes every month. She's maxing out her Roth, and I expect my son to do the same. So it's actually a great way to get a new graduate started off in saving for retirement.
Yeah, that's great. It's a huge leg up.
Tara, could I just ask if you could, maybe Joe could comment on a big question that we get out there is what's the difference between saving in a trust versus the 529 plan? And Joe is an expert on that. That would be a good thing to bring up here because for a lot of grandparents, they might consider putting money in a 529 or should I open a trust? And I think that'd be a good question to get the answer to.
Right. Well, for years and years, attorneys have been working with their grandparent clients to set up education trusts as a way to put money away. 529s, I think, really make that vehicle obsolete because you don't need an attorney to set up a 529 plan. And education trusts are taxable vehicles, so any earnings in that trust are subject to trust tax rates, which are very high on very low amounts of income. So I really think, the 529s are trumping trusts, although in some cases a trust can actually invest in a 529 plan and get the tax breaks for doing that. So it's something to think about if your attorney is talking about setting up a trust, why not a 529 instead?
And we're coming close to 2 p.m. We have 1 minute left. Let's talk quickly about how to make withdrawals. Andrew P. says, what's the best way to make withdrawals? Lump sum? Joe, you want to take that?
Yeah, well, the best way is to take them as early as you can in the college career if you have earnings because they're coming out tax-free, so you're locking in your tax-free earnings by getting the money out while you can. Even if you want to put more money back into the 529, you can do that and for future years, and that way have a higher tax basis in the account, which may or may not help in the future. So the thing to remember is you need to match your withdrawals in a given calendar year with the expenses incurred by the student during the year. You don't have to trace directly from the withdrawal to the payment of the expense. Just match those up within the same calendar year. So if your child incurs $10,000 of college costs during the year, that means you can take out up to $10,000 from your 529 plan with one technical adjustment. Many parents will claim the American Opportunity Tax Credit, so they'll actually be using up some of their tuition for that credit, which no longer is there for their 529 plan. So from that 10,000, you may have to actually subtract 4,000 for 529 purposes, because that 4,000 is going to claim the credit. Now that's complicated, and it's something to talk to your accountant about, but just be aware of how that rule works in general.
Excellent. There are so many more questions. This is frustrating, but we have to close. Thanks to everybody who joined us today. If you have any more questions, feel free to reach out to our panelists through their various websites, which you can find on savingsforcollege.com/529-day, and you can hook up with them directly. And thanks again to our sponsor of today's webcast. Thanks so much.
Thanks.
Thank you.
Thanks.